Have a few minutes? You won't believe what you can do with it. Open a Regions checking account online in as little as 5 minutes. Then enjoy award-winning service and banking tools and tech that help you live in the moment. Learn more at regions.com/live in the moment. Regions Bank, member FDIC.
Live from the Subaru of Gwinnett Studio, inside the Sonesta Gwinnett Place Atlanta Hotel, it's time for Regions Business Radio. Regions Business Radio is presented by Regions Bank. Brave the beginning. Member FDIC. Now, here's your host, J.D. Mealer.
Thank you, Mike Salmon. Good to be with you today. Regions Business Radio Podcast. I am J.D. Mealer, Market Exec and Podcast Host. I need to put that on my business card. Glad to be back with you. We got a fun conversation today. We started a joke a minute ago. You know, there's these jokes, 3 bears walk into a bar. Well, today it's a banker and 2 CPAs. So buckle up for the excitement. But before I get there, Mike Salmon's back with us. He spent a couple of weeks in Japan for the Olympics. Mike, you got a mic over there. How was the Olympics?
It happened. It was we were in a bubble for much of the time I was there, but it was a great experience. Tokyo's an amazing city, and once we get back to normal times, you definitely have to go visit. Nice.
I was thinking about you, and everybody's got their favorite Olympic memory, and they're different for everybody. So, I was a kid, Carl Lewis when he won. And do y'all remember those guys that did the decathlon? They were competing against each other in the decathlon years ago, but there was nothing like Muhammad Ali coming out with that flame in 1996. That may have been
all time,
100%. That voice you hear there is Greg Hayes with Moore Stevens and Tiller. Our other guest is Daniel Sosby. These guys are with Moore Stevens and Tiller CPA here in Duluth. Easy for me to say. And I told Mike Salmon earlier, we're just going to have a geek conversation. So if you want to have a geek episode of podcast, this is it. Mike's got some got something teed up for us. Here we go.
Nerds.
What is a nerd?
There's a roommate, pal!
I'm not kissing a nerd.
I'm sorry. I just had to.
This may not be one you want to listen to while you're driving late at night. You may veer off the road asleep. The excitement level could reach peak.
I don't know about that. Maybe you listen to it to go to sleep. Maybe that's a good thing.
There you go.
But I hope not, because you know what we do. What we do together for our customers, for businesses across Gwinnett, North Atlanta, North Georgia, is very important. And sometimes, we might get made fun of. My daughter's an accounting major at UGA, and I was picking on her yesterday about what size pocket protector she was going to get when she went into CPA school. She didn't really get that. I thought it was, funny as all get out. But the truth is, CPAs and bankers, as it relates to our role for our customers, is of dramatic importance, especially in an ever-changing business environment like we're in now. And I'm not just talking about what's going on with supply chains. I'm talking about what's going on with the rules of the game. They're changing a lot.
Changing constantly, and we are, I think, hurtling toward another era of change between now and the end of the year with tax rates, corporate, individual, estate tax. I think everything is on the table with our friends in Washington. So we want to plan accordingly.
Yes. So with that said, Greg, why don't you start us off with a little bit of intro to Moore Stevens Tiller CPAs? You got several offices and you got a great reputation. Tell us about you guys.
Thank you, JD. Thanks for having us in today. A broad description of our firm. We are, I would say, 140 people at this point. We are a Georgia-based firm. Founded actually back in the mid-'50s down in South Georgia, and we serve exclusively privately owned companies and the families that own them. And that really cuts across sort of a wide variety of different industries: manufacturing, distribution, technology, professional service firms, just a really wide variety of those privately owned companies.
Gotcha. And your role at Moore Stevens Tiller is?
I'm a partner.
Okay.
I just finished up a 5-year stint as managing partner of the firm. Was glad to hand the reins of that job down to the younger generation. But my role really is just in sort of day-to-day client service, problem solving, and directing traffic to get things done within the firm.
I gotcha. I hear you. And Daniel Sosby is also with Moore Stevens Tiller. Daniel, welcome. Tell us what you do there, and give us your perspective on Moore Stevens Tiller, specifically, if you would, in the Duluth area.
Yeah, thank you, JD. I've been with Moore Stevens Tiller now for 14 years. Cut my teeth as an auditor, kind of learning the tax ropes along the way, doing a little advisory, and now for the most part rolling into business development. So for me, that looks like organic growth, new clients coming in, new lines of business, and then also potential M&A for our firm. We're always looking for the other CPA firm in the area that we might converge with, geographic location we may not be in, or an expertise we may not have that can continue to grow what we do for our clients. So I am in the Duluth location primarily. Most of my clients are in the metro Atlanta area, but we have been growing our Duluth office at an exponential rate. We added square footage right before COVID. Who would have thought that might have been a bad idea, but it actually worked out well for us. Mm-hmm. And all of our offices are growing at a pretty good clip. One thing I can say we always pride ourselves on is retention. Most of our employees are kind of like me, well tenured over the 10-year range. So a good group of people to work with.
Very good. Awesome. You mentioned the word retention. We're going to talk about that as sort of a closing topic as it relates for our business clients. I've been starting off our podcast of late with sort of a PPP update. I didn't really have that on my agenda, but I'm thinking about COVID hits. You add staff, you get more square footage. You would think, as you mentioned, that that's a bad time to add staff and square footage, but in fact, it was probably good because the PPP load on CPAs was as heavy, if not heavier in some instances, than it was on the banks. A lot of heavy lifting there.
Yeah, I could say, assistance on some reasonably complex areas of law with respect to PPP, employee retention credit, and some of the other tax incentives, net operating loss carrybacks, and other things that have been put in place purely as part of either the CARES Act or some other type of COVID relief. It just sort of added to the typical deadline and client service work.
Gotcha. For my team, so by way of reminder, my team is Gwinnett North to Highlands, North Carolina, and east to Athens. I got 5 bankers. During the first phase of PPP, we did, just on that team, for our local customers, we did 132 loans and $61 million.
Wow.
Of that, so this was interesting, I found out. The state of Georgia had 112 loans, PPP loans, at the max of $10 million. 3 of them we did at Regions in North Georgia.
Wow.
Of those 3, I believe 2 of them have already been fully forgiven.
Wow. Good for them.
Really, I mean, on top of it,
One quick update there, JD. You're probably aware of this. Certainly, your customers may be, but you'll remember that there was a rule that came out that anyone that got PPP more than $2 million had to sort of go through extra steps to justify the amount of that loan over $2 million. That requirement has been removed. You no longer have to go through, and it was a very involved form that was required for folks with PPP in excess of $2 million. That requirement, again, has been removed. Someone with more than $2 million now just goes through the regular forgiveness process. It's a big deal because that form was nasty.
Was it really? Wow.
Yes.
That's good news.
So it is good news.
I'm assuming that somewhere along the way they figured out a way to audit and make sure that everything was on the up and up, maybe without using a form. But, what was a lesson learned from the PPP process that you guys may recall?
I'd say that, what was I think difficult about that process was just the changing of the rules. I mean, every week, the government, I think, with good intent, rolled this program out, but it was not ready for prime time. And there were constant changes, lots of questions being raised. And I think that confusion can often lead people to sort of just throw up their hands and either not participate, think it's, that there's too much involved. But maybe the lesson learned would be, some patience and the ability to kind of grind it out through that, because the dollars in a turbulent environment like this, those dollars could be the difference between surviving or folding. And I think that sort of patience and, again, ability to stick with it is key.
It makes me think about where we are now, sort of getting away from the rearview mirror and looking at, where we are in the cycle as it relates to PPP funds. This is a pure banking CPA geek question that maybe if there's a CFO or a CEO or an owner listening may appreciate this question, but it's this. How are PPP funds being treated in a financial statement according to perhaps GAAP, or what are you seeing from different banking perspectives as it's being treated? Do you get what I'm saying? Where's it showing up on the P&L?
Daniel, you want to take that?
So since we were going through the 2020 audit season and COVID hit right in the middle of tax season for 2020, we were extending out financials and due dates because essentially PPP came priority. We changed priorities really quickly with COVID came out because it wasn't a matter of getting audited financial statements, it wasn't a matter of getting tax returns done. It's like, all right, survival of the company. So into that, as we started issuing financials and tax returns, as things became more clear, really as forgiveness became known, or the likelihood of forgiveness became known, it goes to the P&L from an other income standpoint. But it is an excludable, non-taxable item, essentially on the tax return. The question at hand was, would the expenses that were offset to that income, would they be a deductible expense? That was a huge question at the beginning of it. Turns out that was essentially negated, and there was no real tax implications at all for the amount of the PPP loan that came through.
So it just goes straight to other income?
Goes to other income, non-operating, sort of below the line.
Right.
Income is where I think we've exclusively seen it. You don't want to have that mixed in
operations,
gross margins, anything along those lines.
Yeah, gotcha. And that's in keeping with how banks are spreading them. I mean, it's other income. Forgiveness, how you account for it in underwriting. If it's forgiven or not forgiven, there's a little bit of a difference there, because I think that we want to know that it's forgiven before it can be officially seen as other income. I guess, is it a liability then? If it's not forgiven when you publish an audit, I guess it's as a liability. Yeah,
if forgiveness wasn't known or likely to be forgiven, then it's still set on the books as a debt obligation to be paid in the future.
Gotcha.
And I'd say just as a matter of just what's going on out there, we haven't seen a single client apply for forgiveness and be denied or even partially denied. Everyone we've seen has been 100% forgiven.
Well, if I look over my universe of the same, Greg, I can't say definitively that no one has been denied, but if they had been, I feel like I'd have been made aware of it.
I think that would be the story. If you saw someone who was denied, that would be.
Yep.
I'd want to understand why. Right? And clearly, if you don't spend the proceeds in accordance with the plan, you'd be denied. But it's pretty clear what you can spend it on, what you should have spent it on. That
Yeah.
So but again, I think people were very careful to apply the proceeds and spend them in accordance. And now that I think the SBA has had some time to build their systems, the forgiveness process is a heck of a lot better than the application process.
Sounds
and all
like it,
the craziness that was going on initially.
Yeah, they were paving the road while they were building it, or driving down the road while they were paving it, however you want to say. PPP's it's part of every business conversation you have at this point. So I just thought, I think it's an interesting topic that 100% of our business customers are dealing with. And look, I'll go back, not to belabor this point, but I can remember having deep, meaningful conversations with clients that were in industries that we knew, entire industries that were likely to die as a result of this thing. And people saying, well, if we're not going to make it, then why take the money? Well, at the end of the day, a year later, they probably could have taken it, and things would have ended up a little differently. That Monday morning quarterbacking is always, beneficial. But nonetheless, I think, too, as a result of COVID, we seem to be seeing a lot of M&A activity. We see a lot of first and second generation business owners that are exiting. It's interesting that third generation business owners statistically do not seem to stay in the family business. But are you seeing the same thing, and what trends are there in not CPA M&A, you guys looking at targets, but within your client base, what are you seeing in regards to selling, purchasing, and preparing for those events?
I would tell you without a doubt there is a lot of merger and acquisition activity, in particular, I think coming from private equity funds and industries that are sort of consolidating, rolling up. It's simply incredible, I think, the amount of capital that is chasing deals currently in the marketplace, and the multiples of earnings that are used to value businesses are stratospheric at this point. I think when business owners, and we work with a lot of multi-generational businesses and maybe businesses that had no intention of looking to sell or exit the business, but when they are approached with this type of valuation, they have no choice but to listen. And so the amount of that capital that's chasing, relatively few deals. The result is the price goes up.
Yep.
And we are certainly seeing that among our client base.
Right. That there's a topic there that I have a little bit of energy around, and it's sort of it sort of conflates what you guys do, what you and your teams do. On one hand, your job is to manage, primarily reporting, oftentimes, if I should say it that way, manage a client's tax liability, which may have an impact on the balance sheet, which will eventually tell the story of the value of the company. And I've had these conversations where a business owner would say, "Yeah, but the business appraisal on this company was $1.7 million, but I think it's worth $5 million." But if you look at the financials, because of their appropriately executed tax strategy, does have an impact when it comes time to sell on the value of the company. Am I saying that correctly? Do you agree with that?
I would agree with that, and certainly, what matters here are the dollars that you get to keep after tax, and the tax structure that you have, how the deal itself is structured as either an asset sale or a stock sale, can have major implications on ultimately whether or not you want to do a deal. When you look at the after tax proceeds, the type of structure you have can be probably the single as a separate item. It'll have the biggest impact on again the dollars that you get to keep, which is the important part.
Gotcha. Yeah, that's the bottom line. Gauge of success is how much are you putting in your pocket.
Yeah, and part of that, is the structure that you're bringing to the table of the deal. Are you a C corporation, an S corporation, et cetera? But then the other half of it is, how is the deal itself structured?
Yep.
In terms of, and again, we won't go down that rabbit hole, but there are a number of different approaches there. So again, part of it is what you are historically. Part of it is what type of negotiation you have and your understanding of the impact of the structure of the deal. In a private equity situation, how much you might be rolling over or investing in the new company, and the treatment of those proceeds. All of those are major components to after-tax cash.
That it's a fun discussion to have, and I agree. We would be talking in these microphones for hours if we went down
absolutely.
there. But let me ask you this: on that topic, if you think about, let's just say 2 years ago, what percentage of your time are you spending on that topic now compared to 2 years ago?
Again, a lot more.
Yeah.
And I there was, I would say, I'm going to say a 6-month pause when COVID first really hit. There was a lot of uncertainty, with businesses and results and what's this thing going to look like afterwards. But it didn't take long, and then I think, coming out of the pandemic, it has been stronger than ever.
Yeah.
And I would agree, too, the fact there's no limitation of revenue. I mean, we're seeing acquisitions for $2 and $3 million companies going left and right versus $20 to $30 million companies. These PE firms or even larger families are sucking up companies left and right, just depending upon the industry they may want to get in, and just looking at these cash flows and multiples they can get. But I would say years ago you wouldn't have seen the $2, $3, $4 million companies being eaten up like you do today.
So with that in mind, and think about the fact that we want more people to hear what you're saying on this topic. So let's just say the podcast gets in the hand of someone in Lawrenceville, Suwanee, Duluth, or whatever, and maybe at the water cooler or at the golf course, they're thinking, number one, I'd like to know what my company is truly worth, which is different than just looking at retained earnings or what your seller discretionary income is. So maybe somebody's listening that wants to know what their business is worth, and they want to be able to identify potential purchasers. Can MST help with that?
We can, in an informal fashion. I mean, we
Okay.
are not certified valuation experts, but our multiple touches on deals both that happen, that maybe get proposed to our clients. A lot of times clients will call us, hey, this guy has approached us. They're valuing our company at X. What do you think about this? And we'll give them some informal feedback based on what we see in our relatively broad marketplace of clients.
Okay.
And we don't handle the valuation part like Greg said, but I would say over the last 4 years, our due diligence quality of earnings work has picked up drastically, where we're going in and assessing whether our client is being purchased and working with the purchaser on a due diligence project, or we've had numerous clients over the last few years also do acquisitions as well. So if it's a smaller company, they haven't had audited financial statements, we go in and do a due diligence Q of E for that client to dig in and find out what's hidden underneath there that may not be presented in a tax return. A lot of times these smaller companies can only really produce a tax return or a QuickBooks set of financials.
Yep.
And that doesn't help you at all in an acquisition.
That's right.
So we have picked up the due diligence Q of E work quite a bit.
Nice. Yeah, it reminds me of some conversations I had through COVID, by the way, with like business consultants, and they were out peddling some business on the 2019 financials. So you say Q of E, quality of earnings, by the way. What define that technically for us? Quality of earnings. What would you do there? Is it akin to an audit, and it's a different cover letter?
It's a little different beast. There's some aspects of an audit built into it. I mean, you'll do a proof of cash concept, looking at the revenue on the books. I mean, does it truly match up to cash deposits coming in and AR going and clearing of A&R, like truly valuing out the revenue.
Okay.
In an audit, you would just sample, but we're looking at true cash flow. I mean, you're going to look at the exposure of potential liabilities out there that may not be captured. So you're looking at things that may not necessarily be on the balance sheet, hidden underneath, like potential sales tax exposure. Is this company filing sales tax in all the right jurisdictions they're supposed to be, or is there something out there they should be filing sales tax in that this client doesn't know about? So we're trying to uncover more or less than test a balance sheet or income statement when you're doing a Q of E or due diligence work.
Wow. Actually, that sounds pretty cool.
And I think going along with just the concept of quality of earnings is also going in and looking at expense trends. And again, as Daniel said, sort of looking behind the numbers. If revenue has been going up at a pretty good clip, but if there are any disturbing trends with revenue, maybe the quality of AR backing up that revenue increase on par. Looking sort of again behind the numbers from a business perspective, not so much from a gap standpoint or
right.
sort of a geek standpoint, but truly from a businessman's perspective, is this P&L and this cash flow production sustainable and legitimate?
Right.
So that's a service that would be basically the acquirer would be most interested in a QA.
We've actually seen it and performed it in two different roles. One, it could be for the acquirer that is coming in to look and, again, sort of look behind the curtains at a business. We will also do what we call preemptive due diligence, where for the seller, we will go in and perform a due diligence process and actually prepare a quality of earnings study anticipating questions that they're going to get in a process, and they can be that much more prepared then when they go through a process.
Well, I would tell you in that regard, if the acquirer, if you're doing this as due diligence, and the acquirer would have to go to, let's say, Regions Bank, for maybe an SBA loan, or sometimes it's not an SBA loan. Maybe it's an acquisition core loan that we could do. A quality of earnings or a due diligence report like that would be as valuable as the valuation. I mean, it would take that valuation and give it even greater credibility, because a lot of times what we see is, a business owner is good at what they do.
Right.
They manufacture this thing and they're really good at it, and they got great people that manufacture the thing, and they want to buy this supplier because it's going to cut down on the lead times and it's going to allow them to buy that product from the supplier more quickly. And in their mind, they're thinking, hey, I'm going to do this and it's going to help my baby, the business that I've grown and I've loved. But if there's a surprise waiting that they're not aware of, they could avoid a catastrophe that was looming anyway. That's interesting,
and that's the idea. I mean, is that you want as much objective evaluation, and an acquisition is a big deal, and in the privately owned company world, either being acquired or acquiring a company is it's not something that you do often, and so when you do it, you want to do it right. And so, this type of process, this quality of earnings, it might be required by your lender. But even if not, I think you want to do it just to make sure that you know what you're getting.
Oh, right? Yeah. Quality of earnings sort of makes me think a little bit about, oh my goodness, it just escapes me. I was about to say it. It's in an entirely different application, and you guys know what it is, cost segregation. Now I'm applying two different things, but a Q of E goes deep into the financials, where cost segregation goes deep into the building of a building or some asset that you purchased. And I don't think a lot of people know that they have these tools in their quiver. Of course, your time, your expertise, your knowledge is worth something, and typically there's a good return on that. So anyway, cost segregation, I think, is an interesting topic. We can talk about that some other time, but it's sort of like cost seg for the financials.
A qualified CPA should bring about that topic to any client out there that's either acquiring and or building a building.
Gotcha.
I mean, that's just basics.
Gotcha. Moving to my next sort of topic. I can't wait to talk to Greg about this one. Daniel, you and I have talked about it a little bit before. With the dramatic change in the business environment, we talked about several things. Connecting the CPA world and the banking world. I enjoy having a conversation about the decision matrix in today's business environment as it relates to which is more important, access to capital or rate and fee. If you can get both, I'm sure that's the preference. But when I say that topic, what comes to your mind, Greg?
Well, it's almost, I would almost view it from our business standpoint. What's more important, the fee that you pay your accountants or the value
Right.
that you get from the services provided? And, the least expensive route is not always the right one. Right. And quite honestly, I mean, interest rates are so low now. I mean, I rarely see a pricing difference being the driver for a client choosing a bank or changing a bank or whatever the case may be. Mm-hmm. It is the banker themselves and the access to that capital that drives the relationship, and the creativity and the thinking behind the providing of that capital.
Yep.
So it in our opinion, interest rate is not the reason that you would make that choice.
I would venture to guess that if a client called you and said, "Hey, Greg, Daniel, we got this piece of equipment that we're going to buy. Could you help us do a quick spreadsheet analysis on which is the best deal from a pure financial standpoint, rate and fee?" I would tend to think, to your point, in today's rate environment, the arbitrage between the low rate and the high rate is probably within 25 basis points.
It is minimal.
Yeah,
minimal.
It's not a lot, as you say, minimal. I like that topic, and I love I know I put you on the spot, and it was a perfect answer, because in our worlds, proving value, especially in my world where we're essentially a commodity, and personality and expertise matters.
JD, you say it's a commodity, and some people may say that an accounting firm is a commodity. Oh, you guys do tax returns and audits. A loan is a commodity. A tax return is a commodity, and I think it couldn't be further from the truth. I mean, it's the experience and the approach to serving our clients and your customers and clients. That's not a commodity.
Yeah, we don't operate that way. I mean,
and I know you guys don't either, but it truly is not a commodity, and there are so many variables, good and bad. I mean, again, in both an accounting firm and a banking standpoint, that I think proves that every day.
I think we had a race to the bottom. There was a period of time prior to 2008 where almost every banking decision was made primarily through a rate lens, and we hopped on board and just wrote it down from a rate perspective, and now we're at a point where we're looking at it and going, I got really good people on my team. I have fantastic bankers, and we're bringing on more fantastic bankers, and I look at it and say, these are people that will return a phone call at 7:00 at night.
Right.
These are people that will step away from a son's basketball game to return a call to a customer. Though, that's meaningful. So are I. I mean, I think that a lot of times, just last week we had a client give us their year-end financial statements. It was an audit. That's why it took so long. And we're just doing a quick glance. We noticed that assets went up and liabilities didn't go up. They had purchased some capital equipment out of cash, and it was a conversation of, hey, would you like to get some of your cash back out of that? Interest rates are extremely low. Let us just lay a loan on that thing for you. They talked to their CPA, and it made some sense, so we're going to do it. My point in bringing up that story is when you get the information, you read it so that you can almost say it back to the client.
Right.
So that they know, number one, that you're reading it, and number two, that you're identifying what's changing in those financials. I think that's value. That's what we should be doing.
Absolutely, yeah.
We have a prospect that wants us to spend more time just sort of thinking through how they can expand. And I think I was reading there was a podcast that I was listening to about a book, and it went back to Warren Buffett about he spends 2 hours a day in thought about business. and we think that we should always be busy, when in fact we should be giving a ton of thought to our clients. You know, there's a business owner in Gainesville that certainly won't say his name, but he pays his CPA firm an hour a month to separate himself from the office and think about the business owner.
Yeah. I mean, I think we operate in that fashion. I mean, we are not we're not the cheapest CPA firm on the block, but when you come to us, you are getting access. I don't do much billable work anymore, but what I do, every single one of my clients have my cell phone number. And I don't know if that's best practice or not, but instead of shooting me an email or phone call, I get texts nearly 7 days a week, all times of the day, because my clients know they can access me and just run any kind of idea they have off us. And I think ultimately that's the goal. I mean, you're building a relationship. It's not about a fee. If they're looking for a fee, then we're not necessarily the right firm for them, because we're in there to grow the business with them and kind of walk with them step by step, day by day.
Yeah, it's awesome. Yeah, I think, do you feel like your relationships are a little deeper and more meaningful than they were 12, 18, 24 months ago?
You know, I would tell you, I think even coming into COVID, that, you know, and to me, it's sort of the meaningful part of our job and what we do is the type of relationship that historically we've had with these clients. I mean, these are it is common for us to have 20 and 30-year relationships with our clients.
Wow.
Often spanning multiple generations, you know, from maybe the start of a business, either passing it on to the next generation, the sale of a business, the starting of another. So, I feel like that's part of what we've done, and what the tool that we've used to grow our practice are those in-depth relationships. And I tell people jokingly that I think our role is about 1/3 accountant, 1/3 psychologist, and 1/3 family counselor. I mean, that is the type of role that we often wind up playing with these companies. And, you know, they know they can come to us for objective, sort of unbiased advice, with any number of, oftentimes financial or tax related,
Right.
But often just business advice. And I'm sure you guys wind up playing a lot of the same role, just based on what you see at other customers and clients, and you can leverage that experience that you see elsewhere on other and help other customers.
Yeah.
With it.
Yeah, that's good. That's good. Part finance, part family counselor, part psychologist. You know, because both of us, both Regions Bank and MST, we're dealing with our customers' most important asset. You know, it's that
Absolutely.
business, and we both share customers that when they lay their head on their pillow at night, they're not just worried about their mortgage; they're worried about 50 other mortgages.
Right.
The rent payment of their employees, and
It's personal.
it is very personal. That's a really good conversation. You know, bringing this in for a landing, if there was a little known piece of accounting or tax advice that you may be comfortable in sharing with our audience, you know, if there was, you know, something out there that someone may be missing, give a second of thought to it, and you know, what would you say?
I'd say this, JD, and I wouldn't necessarily call this little known, but I think that it is certainly worth reminding people, and that deals with the employee retention credit. And that I will tell you that we've had many clients benefit from that credit, and the benefits of that credit can be staggering. It is not difficult to determine if you're eligible for the credit. It's a simple revenue test. Don't let reading something or hearing something overcomplicate that for you.
Right.
Do a little reading. Reach out to folks. Should be reaching out to their CPA and asking if they don't know, they should be asking the question: are we eligible? And if we're eligible, how do we get it? Because I mean, the dollars again can just be it's incredible the amount of benefit that can flow from that credit. And we continue to find folks that maybe thought they weren't eligible, or thought that it was too complicated, or maybe there's not enough benefit.
Mm-hmm.
You got to look into that and see if you're eligible, and if you are, pursue it. And it's easy to test to see if you're eligible, and it's easy to get the credit if you are eligible.
Wow.
I will say, on average, the ones I've processed for clients, the 1 quarter credit is running about half of their PPP loan. So you can get that for up to, is it all 4 credits of the year?
It can be, so
it's through 2021.
Yeah, it's quarterly in 2021.
Yeah.
So you can get it for all 4 quarters. I mean, I've had clients, over $1 million in this credit, and credits of $100,000, $200,000, $300,000 per quarter is not unusual.
Whoa. Wow. I feel like I just released something awesome on the world with our podcast, with you sharing that.
Yeah.
That's and as bankers, it would behoove us to ask our clients, hey, what are you doing with the retention tax credit? Typically we're not gonna. I mean, look, we don't look at many tax returns. In our world, we prefer reviews and audits. But if we ever see a tax return, it would show up there. But that's a dramatic impact that we need to be asking folks
and again,
about.
it's called a credit, but it's a check you get from the IRS. This isn't a tax credit that you're going to get the benefit of going forward, or that you got to have an income tax liability for. You get a check from the IRS for the amount of that credit.
And payroll withholding related. So either if you filed your first and second quarter payroll withholding 941s, you would go in and amend your 941s for first and second quarter if you're applicable or eligible for those quarters. And then if you even choose, you can offset that credit in future quarters and not have to pay in as much for your payroll withholdings. But typically we're advising our clients, just go ahead and, when the 941's due 20 days after quarter end, go ahead and slap that credit on there if you're eligible, and then get that in the subsequent weeks.
Oh, that's awesome.
Yeah, I mean, it's a phenomenal credit. And like I said, there is a stipulation, I think a 5-year statute of limitations on it, where you could come get audited by the IRS for that credit. Mm-hmm. But it's a simple calculation, simple amending of the 941, or adding that credit to your 941.
It almost makes me, in your world, if I'm running an audit, or I'm doing a year-end tax planning for a client, maybe that's just part of the drill. Hey, here's your retention tax credit paperwork. Go file this. In our world, and this we'll close it out on this. In our world, we're moving to more. This isn't tax related, but you see it a lot. We're moving to a point where I think banks will make fraud management services a basic part, a charged part, by the way, not a free service, of treasury and checking accounts. There is so much fraud. So my question to you guys as tax professionals is, it's very similar to a question I asked earlier regarding how much time you're spending on M&A. If you look over the last 3 or 5 years, have you seen a dramatic increase in fraud? And do you see clients moving to things like positive pay with their banking accounts to offset or to protect themselves from fraud?
I would say yes to that question. I would say, especially during the Great Recession, early that time period, we were catching fraud on an annual click for roughly 5 to 6 years there after the recession of 2008 and 9 and whatnot. An audit's not built to do that, but we were catching it through our audit procedures.
Wow.
Where that was clicking off. I would say we're entering a point now of where we're starting to audit 2020, 21 financials. It's plausible our audits could start picking up on things like that. I mean, just based on internal control assessments and testing. So our audit team is aware of what happened 10 years ago. Mm-hmm. And that we have to build in practices and audit testing procedures for that for 20 and 2021, knowing the economic crisis that was put on certain individuals and the stresses that were there financially.
Yeah, I think that's what drives it. I mean, the fear of the stress that we're all experiencing at home, and people get fearful and they make decisions that hurt themselves and others. You got a comment on fraud over there, Greg?
Well, what I would tell you is, I mean, be it either some sort of internal fraud or external, the
Cyber.
the phishing emails, the cyber stuff, is these guys are good.
Wow, they are, aren't they?
Both internally and externally, they're good, and it requires some vigilance and some procedures, and things like positive pay can be huge to filter some of that stuff and give you the best chance you've got to stop it before it occurs.
Mm-hmm. Yeah, I think the truth behind the curtain is that the old banking sort of proof department looks a lot different than it did 30 years ago, and so we don't know what checks you've written. And I'm bringing this up because someone listening may not understand what positive pay is. We don't know what checks you've written. So positive pay is a situation where you feed us a file from your accounting system that tells us the check number, the amount, and who you paid it to.
Right.
What we do is we put that into our teller system, and if somebody presents a check that you've not told us has been written, we'll reject that thing. And we catch a ton of fraud. We hold now, to your point about phishing, that's one of the more scary things, where you have these criminals that can take over your email server and act like you. I've been in a customer's office before, and I'm showing him my email, and I'm sending him an email. He's right in front of me, and it never makes it to him. And then he replies to me, and he's sitting right in front of me.
Wow.
Somebody had gotten in, and I went straight to his office and showed him this. There's no telling how much money because they were requesting a wire. I don't remember what the wire amount was.
Yeah.
But it was that, and that's how it goes.
That's it. There's your sign right there.
Yeah, and for those of our shared customers, whether they do business with us, uniquely together or not, is there's a fee related to positive pay at a bank because we do process those things. We use resources and technology to do that. I can assure you, the monthly fee as it relates to the per item to send that positive pay is much more palatable than when you have your CFO or your controller come in and go, Mr. and Miss Business Owner,
Right.
we've been had for $80,000. You just got to do that, and I'm sure you guys when you look at your controls and those things are out there.
A few years ago, we started building that into our internal controls, maybe more than that, but we always put recommendations. What are you doing? And positive pay was one of those recommendations. If your bank offered it, highly consider it to help eliminate potential fraud.
Yeah. Nobody really realizes that when you send a check, whoever picks up that check has all they need, to get something from you. It's frightening.
Yeah,
it is frightening.
Absolutely.
Closing comments. What would you, if you got a question about Regions at all, you can ask it. But any closing comments, Daniel?
I was going to say thank you, man, for having us out. It's been a blast. We have been working together. I don't even know how long we've been working together. At least over a decade, probably close to it. So MST and Regions have a great relationship, and we thoroughly enjoy working with every single one of your bankers. I know them fairly well, and they're great guys and gals to work with, and our clients have had nothing but the utmost to say when we merge them over to Regions bank accounts, like, hey, these guys are great. So,
awesome.
We just enjoy the relationship.
Thank you very much.
Yeah, man.
Greg, closing comments?
I'll ditto that.
Thank you. Gentlemen, I appreciate you spending a Friday afternoon with us. This is really great content. We appreciate you spending this time and look forward to working with you on future endeavors. Thank you. I hope you have a very good weekend.
Thank you,
Thanks,
Jimmy.
sir.
And thank you for listening to Regions Business Radio. Regions Bank, member FDIC.
Nerds! Nerds!
What is a nerd?